Good morning, everybody. Happy Tuesday. We have an amazing show for everybody today. What do we have, Krystal?
Indeed, we do. Lots of big stories breaking this morning that we want to talk to you about. First of all, market taking a bit of a nosedive yesterday, and some interesting details there about what's going on with crypto, which stocks are sort of leading the decline, and what that is ultimately all about. So we're going to lead the show with that. But we've also got in the show today, Biden planning a major speech today. They clearly realize that just like not talking about inflation is not going to work out for them in the midterms, even with the impending decision regarding Roe versus Wade. Democrats are realizing that inflation will be the number one concern on voters' minds going to the polls. So Biden trying to do some messaging around that. We will break that down for you. Elon Musk making some new, not great comments. At best,
he needs to clarify his
position. Best, not well thought out comments about his plans for Twitter. So we'll talk about that. This story has escaped notice actually for months now, but there is a massive baby formula shortage.
A lot of new moms are really struggling.
Oh, this is really scary stuff. If your baby is wholly dependent on formula and you can't find it at the store at any price, this is a really major problem that is starting to bubble up to the political level. So we'll talk about that, and also some new details about the new press secretary, Karine Jean-Pierre, who is coming in here, at the end of this week?
I believe it's May 17th.
Yeah, something like that. So coming up soon. We're also going to check in with those Starbucks workers who have been organizing across the country. New developments there from the NLRB is filing suit against Starbucks, alleging that they have been engaged in a pattern of unfair labor practices. So we will talk to them about that. But we do want to start with this market crash from yesterday. Let's go ahead and put the Wall Street Journal tear sheet up on the screen. They say stocks slide to lowest in 2022 as rout continues. Technology, energy shares lead declines as NASDAQ falls more than 4%. Here's a little bit of the details from the story. They say the most punishing market sell-off in years showed no signs of abating Monday. U.S. stock indexes slid to new lows for 2022. Other assets like oil and Bitcoin tumbled as well. S&P 500 fell 132.1 points, or 3.2%, adding to losses after closing out its longest streak of weekly decline since 2011. Monday marked the first time the index closed below the 4,000 level since March 2021. NASDAQ tumbled for more than 521 points, or 4.3%. Dow Jones shed more than 653 points, or 2%. And part of what they point to in this article, Saagar, is, of course, you guys know what the landscape is. You continue to have these supply chain issues. You have lockdowns in China, which are getting even more draconian, if anything. You obviously have the war in Ukraine causing all kinds of issues, from food prices to gas prices. And you also have the Fed engaged in significant tightening. Now, last week when we talked to you about the Fed moves, so they had already lifted interest rates 1/4 point. Last week, they lifted it 1/2 point, okay? And markets were a little bit reassured by Fed Chair Jerome Powell coming out and saying, listen, we're not contemplating going any further, any faster than what we're doing right now. Also giving a look into how they are going to unload the assets that they have accumulated off of their balance sheet, which also has a tightening effect. So the day after that, we actually did the show, said actually markets responded fine.
Yeah, they were actually went up a little bit.
Yeah, people were reassured by the fact that, okay, Jerome Powell says they're not going too far too fast. However, now you have a new inflation report set to come out this week. And I think there's a lot of nervousness that if that inflation report continues to be high, that even though the Fed says they're not going to go too far too fast, they might reassess that if inflation is not ultimately getting under control. So that's what they point to in this article. They say later this week, investors will get another read on inflation when the Bureau of Labor Statistics releases its consumer price index. They're expecting data to show that inflation fell a bit from March's level, but if that comes out higher than expected, that is going to be a major issue. And they say that the feeling of reassurance that came from the Fed's comments last week soon gave way to anxiety as investors grappled with the reality that the Fed might be forced to rethink its plans if inflation fails to ease up in the coming months.
Yeah, and let's just really stick with the Fed, because I think that's, look, if there is a recession, if there is a dive, it is almost entirely a Fed-triggered event. Now let's put this up there on the screen. So the Journal actually does a great job of describing this. Fed rate hikes are good for banks, unless they end in a recession. No. So they're like, yeah, higher rates are usually good news for banks, but not this year, because people are worried that the Fed will push until something breaks. And what they they point to is that JP Morgan, Goldman Sachs, Bank of America, Morgan Stanley have all dropped this year despite 2 years of big pandemic gains and despite the fact that in almost every case in previous history, bank stocks go up whenever higher rates are there because they're set to make more on the interest. But investors worry that rate increases that are too big, too fast, will tip the economy into recession. And I think an expectations game is very important here. Look, the idea that all of this is, tucked by fundamentals and everything is right under there, and it's like you can, go underneath and be like, this is all backed by some real stuff. Almost entirely expectations is half, if not more so, of the way that investors are feeling about the current price of the market. Well, if investors worry that rate increases are too big or too fast, could tip the economy into recession, the sell-off itself could trigger a recession, which would then trigger more Fed activity. So there's a self-fulfilling prophecy, which is ideological and which could very much come to pass in this case. But really what they say is that the current expectation is that the Fed is going to push so far, so fast on high interest rates that the banks will not be able to recoup any of the profits. And if anything, all across the entire economy, we're going to see a downturn. And the reason that this really worries me is, look, we've told you guys this before. You may not make money on the way up, but you will lose money on the way down. And the reason why is that the tightening of capital, I'm already seeing it. I have friends who've already been laid off as a result of the fact that their companies could not raise the amount of money that they were promised. And listen, that's in the private markets and venture capital. They're probably like the tip of the spear who are going to get affected. But they're just the first. How many more recessions or how many more layoffs are coming? And the reason why I say that is, remember the Great Recession of 2008? Part of the reason we had to bail the banks out was because many companies, corporations, were taking short-term loans in order to make payroll. So if we didn't bail out the banks, these people were not going to make payroll, and they're like, we had to fire everybody on Monday. So these are the types of decisions which very much could come to pass. A lot of people were maybe planning expansions on their investor calls that they won't be able to finance at much higher interest rates. Look at the mortgage interest rate and then consider the commercial ones. Commercial interest rates are not necessarily at the same rates, but, I was actually just talking to a guy yesterday about this. The commercial real estate interest rate game is even more murky because they don't have set standards, Krystal. A lot of it is that the loans are so big and the interest that they make is so much that there's a lot of jockeying. And as we've talked here before, a lot of these big firms, Fortune 500s, have been able to just say, just trust us. And the banks don't really do their due diligence. So in a high interest rate environment, if you continue to kick that up, a lot of these corporations, don't underestimate this, will not be able to make basic cash expectations. They're just going to have to fire people on a dime as in these crazy ups and downs. Like, uncertainty is what causes real effects for you. And that's why I think a lot of people should pay attention to this.
That's exactly right.
Yeah.
The whole goal of the Fed is to be able to engineer a quote unquote soft landing.
Right.
This is no easy feat, especially when the only tools the Fed has at its disposal is basically to lessen demand from consumers. So to cool off the hot housing market in particular. And already you've had residential mortgage rates skyrocket, going up at some of the highest rates in history. And you now have the median mortgage price, the cost of mortgage, monthly cost of mortgage, has hit a new historical high because of how much interest rates matter in terms of what that month-to-month payment ultimately is. So you have the Fed trying to sort of tamp down demand and put the brakes on what consumers are able to spend. And at the same time, you all have all these global forces that really have nothing to do with that. So it's a very treacherous landscape. At the same time, we just got a jobs report that was actually quite good,
But
so
not in pace with inflation.
That's the thing. So you have this very mixed picture where, yes, the economy continues to create jobs at a rapid clip. Yes, unemployment continues to be quite low. But people are feeling the pain in terms of what they are paying at the grocery store, what they are paying for housing, what they are paying for at the gas pump, which I know is something that you're covering today, Saagar. Right. And so it is, listen, it's not an easy thing that the Fed is trying to pull off here. And clearly there is a lot of nervousness in the market about what this is all going to look like. And listen, the bottom line is this. The Fed's policy during the COVID recession was to inflate asset bubbles.
And the decade prior, Krystal.
Yeah, well, that's exactly right. I mean, this started with the Great Recession. That was the initial foray into zero interest rates and quantitative easing. They went even further during the COVID market crash. There was a minute where the market was just like in free fall. Even Treasury bonds, which should be the sort of most stable and most liquid of markets, that was even seizing up. And they looked at that landscape and not incorrectly said, we have to take extraordinary action here. And they did, shooting trillions of dollars to backstop both the bond and the stock markets. Now that inflated these, massive asset bubbles. Before we had basic consumer inflation, you had inflation at this very high level in terms of stock and bond prices. And now what you were talking about how much the sentiment matters, like those asset prices were not really based on reality. As we all know, the stock market, like valuations are kind of fake. So the minute that there's this reckoning of like, oh my God, this constant bull market is not going to last, then you can have panic, then you can have selling off, and that's when the bubble can ultimately collapse. And that's why we're in dangerous terrain here. That's why you continue to see, the markets going down and down and down. You'll have one day where they sort of tick back up, and then you go back into this pattern that we've been seeing for weeks and weeks now. Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.